Hey everyone, welcome back to Corporate Decoder. Today, PGIM Global Total Return Fund, Inc. just filed its semi-annual shareholder report, and I am digging into the financials to see what is really going on. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows us exactly where the fund is putting its money and what kind of risks it is carrying as of the 30th of April 2026. So we're looking at a snapshot of the PGIM Global Total Return Fund and the PGIM Global Total Return USD Hedged Fund. These are essentially investment portfolios that aim to grow your money through income and appreciation. Think of them like big baskets holding lots of different investments, trying to make more money over time. This report is filed to give shareholders all the important details about how their money is being managed. It covers the period from the 1st of November 2025 to the 30th of April 2026. Let's talk about costs first because that directly impacts your returns. For Class A shares of the PGIM Global Total Return Fund, a hypothetical $10,000 investment would have cost you about $44 over these 6 months. That is a pretty small percentage, only 0.88%. But for Class C shares, that same $10,000 investment cost $81, which is 1.63%. Class Z shares were the cheapest, costing only $31 or 0.63%. This shows that different share classes have different fees, and it is always good to know what you are paying. Now, for some key numbers, as of the 30th of April 2026, the PGIM Global Total Return Fund itself held a massive $2,597,275,788 in net assets. That is nearly $2.6 billion. It held 1,428 different investments, and its portfolio turnover rate for this period was 16%. Turnover rate tells us how often the fund is buying and selling its holdings. A lower rate generally means a more buy and hold strategy. This is where it gets really interesting. Let's look at the credit quality of the fund's holdings. Remember, credit quality is like a rating of how likely an investment is to pay back its debts. AAA is the highest, meaning very safe, and D means defaulted or in deep trouble. AAA rated investments make up 16.9% of the portfolio. That is good to see, showing some really safe holdings. AA is 13.8% and A is a big chunk at 25.1%. Then we have BBB, which is 32.4%. This is often considered investment grade, but is starting to get a little riskier. Below that, we see BB at 6.2%, B at 1.3%, and CCC at 0.7%. These are considered speculative or junk bonds and carry a much higher risk. The fund also has 0.1% in D-rated debt, which means it is in default. Finally, 2.3% is not rated and 1.1% is in cash or cash equivalents. You can see the fund is holding a significant portion in investments that are not top tier quality. This report dives deep into the actual investments. Almost all of the fund's assets, 98.2%, are in long-term investments. This means they're not expecting to cash out these investments quickly. Scroll Asset, backed SE Securities, 1.7%, Fine Center, a small part, 1.7%, is in asset-backed securities. These are backed by pools of assets like credit card payments or loans. For example, there is an Evergreen Credit Card Trust Series 2024 CRT 04 Class C security, with a 5.640% interest rate maturing in October 2028. Its value is over $5.6 million, scroll commercial mortgage. Backed SE Securities 2.0% Swy Center. Moving on, 2% is in commercial mortgage-backed securities. These are backed by loans on commercial properties. There is a BX Commercial Mortgage Trust, Series 2024 Pure, Class A with a 4.191% rate and a maturity in November 2041. Valued at almost $3 million. Scroll Corporate Bonds 41.2%, Phi Center, a huge chunk 41.2% is in corporate bonds. This is where the fund is lending money to companies. We see bonds from Australia like Mineral Resources Limited with various interest rates and maturity dates. There are also bonds from Brazil, including Petrobras, Global Finance, BV notes paying 5.375% and 6.625%. These corporate bonds represent a significant part of the fund's risk and return potential. Now, for some of the safest bets, 13.7% is in US Treasury obligations. These are backed by the US government, so they're considered very low risk. We see a lot of different bonds and notes here, with interest rates ranging from 1.125% to 5% and maturities stretching out quite a bit, some even past 2050. The total value here is over $354 million. This provides a strong foundation for the portfolio. A very large portion, 36.1%, is in sovereign bonds. This means the fund is lending money to governments. We see holdings in countries like Bulgaria, Canada, Chile, China, Colombia, and many more. For instance, there are Colombian government international bonds with rates from 3.75% up to 11.85%. The sheer diversity here shows the fund is indeed global, but it also means it is exposed to the political and economic risks of many different countries. They also hold some options purchased worth about $983,000 and warrants. These are generally used for hedging or seeking specific exposures, but they represent a very small part of the portfolio. Overall, the fund is heavily invested with 98.1% in long-term investments. This means they're looking for growth over a longer period. Then there is 1.4% in short-term investments. This includes money market funds, which are typically very safe and liquid. Specifically, they have nearly $6 million in the PGIM Core Government Money Market Fund and about $28.7 million in the PGIM Institutional Money Market Fund. These are likely used for managing cash and providing liquidity. Looking at the statement of assets and liabilities, total assets are over $2.65 billion. On the liabilities side, we see significant amounts for options written, which means the fund has sold options and could be obligated to pay out if those options are exercised. There are also substantial liabilities related to swaps and forward contracts. Showing active use of derivatives, scroll net assets $2,597,275,788 Psi Center. The net assets of the fund stand at about $2.59 billion. Then we get into the details of different share classes. For Class A shares, the net asset value per S-share is $5.29. This is the actual value of each share. There is also a maximum sales charge of 3.25%, meaning buying into this class might cost you extra upfront. Class C shares have a net asset value of $5.28 per S-share. Class Z shares, which are usually for institutional investors, have a net asset value of $5.32 per S-share. For Class R2 shares, the net asset value is $5.36 per S-share. Class R4 shares are also at $5.36 per S-share, and Class R6 shares are at $5.35 per S-share. These different classes reflect different fee structures and target investors. In the statement of operations for the 6 months ending the 30th of April 2026, the fund generated about $48.8 million in interest income. This is a key driver for income funds. Total expenses for the period were around $7.9 million, but after fee waivers and reimbursements, the net expenses were closer to $7.7 million. The management fee alone was over $6.4 million. This resulted in a net investment income of over $41 million. However, looking at realized and unrealized gains and losses, the fund had a net realized loss of nearly $27.6 million on investment transactions and a significant net change in unrealized depreciation of over $21 million. This means the value of their investments dropped overall during this period. When you combine all these, the net result was a loss of about $20.5 million on investment and foreign currency transactions. However, after accounting for all operations, there was still a net increase in the fund's net assets of about $21.2 million, which came from share transactions. The expense ratio after waivers is 0.88%, which is pretty standard for this type of actively managed fund. Now, for the financial highlights for Class A shares, the net asset value per S-share started at $5.35 and ended at $5.29. The total return for this 6-month period was 0.68%. For Class C shares, the net asset value went from $5.34 to $5.28, with a total return of 0.31%. Remember, Class C shares generally have higher expenses. Scroll Class Z shares, C-Center Class Z shares, typically for lower cost institutional investors, saw their net asset value go from $5.38 to $5.32. With a total return of 0.81%. Then we have the PGIM Global Total Return USD Hedged Fund. This fund aims to achieve total return with a focus on managing currency risk. For Class A shares, the net asset value per S-share is $8.67. The total return for this 6-month period is actually negative at 0.32%. For Class C shares, it is $8.66. Per S-share with a negative total return of 0.69%. Class Z shares are at $8.66 per S-share and had a negative total return of 0.19%. Class R6 shares are at $8.67 per S-share and also had a negative total return of 0.05%. This particular fund seems to have struggled more in this period. We also see a lot of detail on derivative instruments like swaps, forwards, and options. The fund is actively using these to manage risk and potentially enhance returns, but they also add complexity and their own set of risks. For example, the schedule of investments shows extensive holdings in corporate bonds and sovereign bonds. indicating a strategy that balances risk and return across different sectors and geographies. The large exposure to sovereign bonds from various countries highlights the global nature of this fund, but also introduces country-specific risks. What stands out here is the fund's active use of derivatives, especially interest rate swaps and credit default swaps. These are powerful tools but can also amplify losses if markets move unfavorably. The significant holdings in both corporate and sovereign bonds, with a considerable portion in less than top-tier credit ratings, show a willingness to take on more risk for potentially higher returns. In my opinion, this fund is playing a complex game. The strategy involves a lot of moving parts with those derivatives and a wide range of credit quality in its bond holdings. While the fund aims for total return, the significant unrealized losses suggest that the market conditions during this period were challenging for its chosen strategies. The higher expenses for some share classes, like Class C, directly eat into returns, making Class Z or other lower cost options more attractive if you qualify. I am watching closely to see if this strategy can pay off in the long run or if the complexity adds too much risk. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this valuable, hit like and subscribe and join our Discord linked below.